I'm often asked the question, should I fix a mortgage? Should I have a variable mortgage? Should I do 2 years, 5 years? What should I do? So we're gonna look at some of the different options. So some people who've come to the end of their mortgage are on very, very expensive mortgages, whether they're a homeowner or a property investor, and it's costing a lot of money. Now, the point is, no one knows with certainty what's going to happen in the future. We can have a guess, we can estimate, but no one really knows. So my recommendation would be, and this is what I am doing, and it means I pay a little bit more interest, obviously on that arrangement fee as well as the actual amount I borrowed. But the point is, it doesn't affect my cash flow too much. If I was to pay that fee up front, that would be a big chunk of cash I've got to pay out, especially on some of my bigger properties. Hello and welcome to this episode of the Property Magic podcast, in which we're going to be talking about mortgages. I'm often asked the question, should I fix a mortgage? Should I have a variable mortgage? Should I do 2 years, 5 years? What should I do? So we're going to look at some of the different options and help you understand what might be best for you with your property investing. Now, also, I want to touch on remortgaging as well, because people say, well, should I remortgage now? Should I wait until interest rates improve? So we're going to talk a little bit about what might happen to interest rates and how that affects your decision about how and what you should be doing with your mortgages. So first of all, if you are on a standard variable rate, that's where you have a fixed period of time, maybe a discounted or fixed rate for 2, 3, 5 years. At the end of that, you generally go onto the lender's SVR, which is standard variable rate. That is normally the Bank of England rate plus a certain percentage. It might be 3%, could be 5% in some cases. So some people who've come to the end of their mortgage are on very, very expensive mortgages, whether they're a homeowner or a property investor, and it's costing a lot of money. And I think they're kind of waiting to say, when is the best time to refinance? Look, at the moment, the Bank of England has just announced they are freezing interest rates, the base rate at 4%. And I think that will probably be the case until inflation gets under control. At the moment, inflation is 3.8%, which is almost double the target of 2%. Wage inflation is something like 4.9%, and food inflation is 5.1%. So the Bank of England that use interest rates as a macroeconomic tool to control inflation have quite rightly kept it fixed at 4%. And it might well be the case. In fact, if inflation goes up that much more, maybe they might increase the rate. Now, the point is, no one knows with certainty what's going to happen in the future. We can have a guess, we can estimate, but no one really knows. So my recommendation would be, and this is what I am doing, when I've got mortgages that come to the end of their term, instead of going on to the expensive variable rate, I am fixing those mortgages. So I am remortgaging. The rates right now, I think, are pretty reasonable. They're not as good as they were a few years ago where the base rate was only 0.5%, but I don't think it will ever go back to that 0.5% base rate. So personally, I am fixing mortgages coming towards the end, and I'm generally fixing for 5 years. Now, I'm not giving you advice here. I'm just showing what I am personally doing. If the rate's good, I like to fix for 5 years, because I think, okay, at least for the next 5 years, I know exactly how much I'm going to pay. In 5 years' time, we don't know where we're going to be. We don't know what rates will be. We don't know if we're going to have a new government by that time, probably, who knows. So I'm fixing, okay? Now, an interesting thing I've noticed about mortgages at the moment. There are some lenders who are charging very, very high arrangement fees. These are fees that you pay to arrange a mortgage. The lowest ones I've seen recently are down at 2%, but most of them are 3, 4, even 5%, even up to 7% arrangement fee. Now, why are these arrangement fees so high? By the way, you can either pay the fee up front or you could just add it to the loan normally. The reason they're doing very high arrangement fees is because if you have a normal interest rate, it's very difficult to get the property to stack up and the numbers to work. So what they're doing, they're lowering the interest rate we pay, but then loading the difference into the arrangement fee. So you might be paying a high arrangement fee, that means you're probably paying a lower rate. And whenever lenders say, well, you can either have a 2-year fixed, a 5-year fixed, you can have this fee or you can have this rate, I always do a little spreadsheet to work out overall which is going to be the more cost-effective one for me. Generally, I prefer to have a lower monthly rate, a lower annual rate, because it means I have better cash flow, and a slightly higher arrangement fee. Because I'm going to add the arrangement fee onto the loan, and it means I pay a little bit more interest, obviously, on that arrangement fee as well as the actual amount I borrowed. But the point is, it doesn't affect my cash flow too much. If I was to pay that fee up front, that would be a big chunk of cash I've got to pay out, especially on some of my bigger properties. But actually, I don't mind putting it onto loan because I know that in 5 years' time, or I expect the value of the property is going to be so much more anyway, that fee will be swallowed up by the natural growth in the property market. And we have this natural growth because in the UK, we live on an island with a limited amount of accommodation and an increasing population. And that means over the long term, both rentals go up and also property prices go up as well. Now, obviously, property prices don't always go up. It's a cyclical market. We've seen booms. We saw a massive unexpected boom during COVID because of the government intervention where they introduced the stamp duty holidays, which stimulated the market. And also they had the bounce back loans to help businesses that are in difficulty. Now that money wasn't supposed to be used for property, but I'm pretty sure lots of that money found its way into the property market. This is why we had this unexpected boom in the COVID years. And then we've had a slight correction and a tail off of prices. And now we're in this buyer's market. We're in this buyer's market where there are more people looking to sell than there are looking to buy. That means it's not so good if you're looking to sell a property, but it's great if you're looking to buy. Now, I know lots of investors are waiting, hoping interest rates will come down, and they're thinking, well, surely that's a better time to buy property. If I'm paying less each month on my mortgage, I'm going to make more cash flow. Whilst that's true in theory, I think if interest rates do come down over the next 6 months or so, more people are going to come back into the property market wanting to buy property, the demand will go up, and thus people are paying more for their property purchases. So although the amount you might pay each year in terms of interest rate might come down, you might have a higher mortgage because you're buying the property at a higher price. And also, when more buyers come back to the market, that's more competition for you looking for those great deals. So I would suggest if you can find an interest rate that works now, I'm personally fixing for 5 years just to have that stability, and I'm happy to offset that high arrangement fee against the value of the property because I know over time that's going to be wiped out. So that's my personal policy. That's what I'm doing when I'm buying property. Just something else to mention here. Very often people, when they're new to property, they say, well, should I have a repayment mortgage or should I have an interest-only mortgage? Now, on your own home, people often have a repayment mortgage because at some point you have to pay your own home back. Assuming you want to continue living there, when you get to a certain age, you're going to retire, you're not going to have as much income, you can't afford to pay the mortgage. That's why people generally pay the mortgage off by the time they retire. So that's why we have a repayment mortgage. However, as investors, we have interest-only mortgages where each month we're just paying for the interest on the borrowing of that property. Let's say we buy a property at 200,000 and we get a 150,000 mortgage, which are 75% loan to value. If we get interest only for 20 years, we might have a 3 or 5 year fixed or discounted rate, and then after that it goes to the standard variable. But over that 20 years, we're paying interest every single month, and in 20 years' time, with an interest-only mortgage, we still owe the £150,000. But the value of the property will have gone up in that time. In 20 years, it probably would have almost certainly doubled, maybe even doubled again. So the £200,000 property will probably be worth at least 400, maybe 5, 6, maybe even 800,000. Some of my properties have doubled and doubled again in a 20-year period. Let's be really conservative. Let's say the property is just worth £500,000 in 20 years' time, and we bought it for 200,000, and the mortgage was 150. So in 20 years' time, the mortgage is still 150, but the value is now 500. And we can either remortgage that with another lender, we can sell that property and pay the tax, the capital gains on it. But the whole point is we only pay the lender back the 150. They put in 75% of the money and we pay the monthly interest for that, but we get all of the profit at the end of the day. So I think being able to borrow from banks is amazing. And they're very happy to lend money to us to buy good properties because they know property is one of the safest investments you can make. Of course, you need to know what you're doing. And some people lose money, they make mistakes. I've made loads of mistakes in my 30 years of property investing. But when you educate yourself, when you learn how to do this properly, you can minimize the risks and you can maximize your return. So when we're buying investment properties, generally we get interest-only mortgages. I know some people, they want to have repayment mortgages and pay the mortgages down, and they're thinking a bit like a homeowner. And eventually you'll have a lot more cash flow from the property, but it means at first, for the first few years, before rents have gone up, you might not be making much cash flow from the property. And you might be happy with that, but I always want to buy property that gives me really good cash flow. It's one of my golden rules. In fact, golden rule number 3 from Property Magic: we only buy properties that give us positive cash flow. Sometimes people buy property with the hope it's going to go up, and it probably will go up over the long time, but there's no guarantee that's going to happen. And so we want to make sure it's making money for us today. And if the long-term growth happens, well, that's the icing on the cake. So when we get mortgages, generally we're getting interest only on investments, and we're getting capital repayment on your own home. The exception to that is maybe if you've got lots of equity in your own home, you might decide to refinance that to take a load of money out and use that to go and buy some investment properties. And the reason people do that, they buy investment properties, the value of those go up over time, they then refinance those and use that to pay back your own home. So by using equity in your own home, or maybe an inherited property, you can grow a portfolio that's an asset you can hold on forever, giving you cash flow, giving you long-term wealth, and then use it as a way of paying back your own home loan, because you do need to pay that own home loan back. And I see some people get into the problem where they've got interest-only mortgages, they get to a certain age, and suddenly they need to find a whole load of money to pay off their house. So that's going to be difficult unless you're investing in other assets, such as property business, to give you a profit in order to pay your home back. If you are refinancing and taking out a load of money, you probably want to do it on your own home. You probably want to do it as interest only, because if it's repayment, the payments will be too much. The cash flow is not going to be very good. So do interest only, knowing that you will have a mechanism to pay back your own home, which is the capital growth on the investment properties you've been able to buy thanks to the equity released from your own home. I've talked through that pretty quickly, but I hope that makes sense. I have talked about it before on some of these podcasts. This is what you need to do. And the final point I want to mention, and I did mention this on a previous podcast very recently, is I see people who've got properties, they may be rental properties, they've got assets, they've got lots of equity that could be used to buy great deals in the market right now, and they decide not to use that for 2 reasons. One is they're uncomfortable with using equity in the property because they're thinking like a homeowner, wanting to pay them down. Or sometimes maybe they're locked in for a period of time, 1 or 2 years. And I had a conversation with someone last night at a PIN meeting who said, yeah, I've got money I'm going to use in 2026. And I said, well, why next year? And he said, well, it's all locked up. There's a redemption penalty. And he can release about £100,000. And I said, well, maybe you should look at how much that penalty is going to be. If you were to release the money now, the next month or 2, maybe pay that penalty, because you've got to think about if you invested that £100,000 in a property, you could buy maybe £400,000 worth of property, you can get cash flow from that. And what growth would you get over the next year? Probably far more than the penalty you're going to have to pay for accessing that money in the first place. And I guess sometimes people look at costs and they obviously don't want to spend money they don't have to spend. I get that, but you've got to look at the opportunity cost of not being able to use that money in some other property investments. So I do hope this has made sense. If you like this video, please like the video. Please subscribe to the YouTube channel and hit the bell icon to make sure you're notified anytime we bring out a brand new video. Until next time, thanks for listening, and I encourage you to invest with knowledge, invest with skill.